1. Start with energy, explain with authority, highlight with emphasis, and with warmth. The current live trading price for Applied Digital Corp stands at 24.52 USD, surging upward with a gain of positive 1.43 USD, marking a significant 6.21% increase intraday as of this very moment on November 20th. While the broader market might be distracted by the daily noise of megacap indices, what you are seeing on the chart for ticker APLD is the potential ignition of a massive short squeeze in one of the most controversial names in the AI infrastructure space. The green candle forming on your screen right now is not random volatility. It is a direct response to the market pricing in the successful closing of a massive $2.35 billion financing deal that many skeptics said would never happen. The expectation from the bearish camp, who have aggressively shorted nearly 33% of the floating shares, was that Applied Digital was biting off more than it could chew. A small-cap company drowning in ambition and debt, destined to dilute its shareholders into oblivion before its massive data centers ever came online. That was the narrative that pinned the stock in the low 20s. But the reality we are confronting today is that the company has just secured the war chest needed to fully fund its Polaris Forge campuses, effectively locking in the capital to execute on billions of dollars in signed leases. The shorts are now staring at a fully funded balance sheet and a construction timeline that is hitting its milestones, creating a divergence between their bankruptcy thesis and the execution reality that could force a violent covering rally. If you are watching this ticker on your Fidelity mobile app or tracking the order flow on Interactive Broker's stock trading platforms, you need to understand the specific mechanics of today's move. November 20th was the target date for the closing of the $2.35 billion senior secured notes offering. The fact that the stock is bidding up strongly suggests that the smart money is front-running the official confirmation or reacting to the lack of any negative delays. This isn't just about borrowing money, it is about validation. In a high-interest rate environment, you do not lend $2 billion to a company unless you are absolutely certain their customers, specifically the hyperscalers renting the space, are going to pay up. This financing acts as a seal of approval from the credit markets, which are notoriously more diligent than the equity markets. For the traders engaging in online investing who have been eyeing this stock, the removal of the financing risk overhang is the catalyst that changes the entire investment calculus. Let's dissect the expectation versus reality dynamic that is driving this trade. The expectation is that Applied Digital is simply a landlord for servers, a low-margin, capital-intensive business that competes with giants like Equinix or Digital Realty. Investors look at the negative earnings per share and the massive capital expenditures and recoil. The reality, however, is that Applied Digital is not building standard data centers. They are building AI factories. These are high-density, liquid-cooled facilities designed specifically for the thermal profile of NVIDIA stock Blackwell chips and future GPU generations. Standard data centers cannot handle this heat density. There is a structural shortage of this specific type of power capacity in the United States. By securing the land, the power permits, and now the funding, Applied Digital has effectively cornered a piece of the most valuable real estate in the digital economy. They are not just renting space, they are renting access to the AI grid. The intraday volume is confirming this bullish thesis. We are seeing elevated turnover, and if you look at the options chain, the call buying activity is aggressive. This puts pressure on the market makers to hedge their exposure by buying the underlying stock, adding fuel to the fire. With nearly 80 million shares currently sold short, any sustained move above the $25 resistance level could trigger a cascade of buy stops. This is the pain trade for the bears. They are paying a borrow fee to hold a position against a company that just secured 15 years of guaranteed revenue from some of the largest tech companies on the planet. It is a precarious position to be in, and the 6% move today is the sound of the exit door beginning to creak open. For those of you managing your own individual brokerage accounts or using Schwab Intelligent Portfolios to allocate to the AI theme, you have to look past the headline valuation. Yes, the price-to-sales ratio looks steep if you look at trailing 12-month revenue, but the market is a forward-looking mechanism. We are pricing in the revenue from the 400-megawatt Ellendale campus and the 300-megawatt Harwood campus. The recent lease agreement with a U.S.-based investment-grade hyperscaler, widely speculated to be a major tech titan, covers 200 megawatts and is worth approximately $5 billion over its life. When you layer that on top of the existing $11 billion contract with CoreWeave, you have a backlog that dwarfs the current market cap. The reality is that this company is trading at a fraction of its future contractual cash flow, provided they can build the buildings. And that brings us back to today's news. The money to build the buildings is now in the bank. Let's talk about the Polaris Forge projects, because the scale here is hard to comprehend without context. Polaris Forge 1 in Ellendale, North Dakota, is a 400-megawatt behemoth. To put that in perspective, a typical large enterprise data center might be 20 or 30 megawatts. Applied Digital is building cities of compute. Phase 1 is already coming online. The ready-for-service announcement for the first building was a critical proof of concept. It proved to the doubters that this management team, led by Wes Cummins, could actually navigate the supply chain and construction challenges in rural North Dakota. Cummins is an interesting figure here. He is not a traditional construction CEO. He is a former tech investor and hedge fund manager. He understands the capital markets game intimately. He knows that in a capital-intensive industry, access to cheap capital is the competitive advantage. By structuring these deals with Macquarie Asset Management and securing the debt financing, he has engineered a way to build billion-dollar assets without completely diluting the common equity holders to zero. I want to pause here and ask you to engage with this scenario. Comment below with your take. Do you think the unnamed hyperscaler is Microsoft, Google, or Amazon? And if you are short this stock, what is your stop-loss level? The speculation on the tenant identity is a massive driver of sentiment, so let's hear your theories. We must also address the high-performance computing cloud services aspect of the business. While the leasing business is the steady anchor, the cloud services division is the high-octane growth engine. This is where they own the GPUs and rent them out by the hour or month. This segment offers much higher margins, but comes with higher obsolescence risk. The market has been skeptical of this segment recently due to the rapid depreciation of GPU hardware. However, with the insatiable demand for training clusters, Applied Digital has been able to keep utilization high. The reality here is that they are pivoting. They are focusing more on the infrastructure layer, the buildings, because it's a 20-year asset class, rather than the chip layer, the GPUs, which is a 3-year asset class. This reduces the long-term risk profile of the company and makes it more attractive to pension funds and Fidelity Wealth Management advisors who want stable, infrastructure-like returns rather than wild tech speculation. The relationship with CoreWeave is central to the thesis. CoreWeave is the golden child of the AI startup world, backed heavily by NVIDIA. Their success is Applied Digital's success. As CoreWeave expands, they need more power. Applied Digital is their landlord of choice. This symbiotic relationship reduces the customer acquisition cost for Applied Digital to effectively zero for a huge chunk of their capacity. They don't need a massive sales force. They just need to pick up the phone when CoreWeave calls. However, this also creates customer concentration risk. If CoreWeave were to stumble, Applied Digital would feel the pain immediately. This is the risk you accept for the explosive growth. It is why SoFi Invest rates this as a high volatility holding. Let's look at the technicals on the chart. The stock has been carving out a base in the low 20s for weeks, absorbing the supply from the recent equity issuance. The breakout today above the moving averages signals a change in trend. Traders using Robinhood stock trading apps love these setups. A fundamental catalyst, funding secured, meeting a technical breakout, price moving above resistance. The next major resistance levels are at $28 and then the psychological $30 mark. If it clears those, there is very little overhead supply until the old highs near $40. The air pocket above $30